Welcome back to Alpha Recap. I'm really glad you joined us. Quick heads up, markets close for the day, and if you have questions, you can always reach us at stockalpha.ai. Today we're unpacking a risk-off session that sent major indexes lower, small caps lagged, and headlines did a lot of the heavy lifting. Jonathan, great to have you.
Thanks for having me. Always good to dig into these days where the market moved together, but for different reasons.
All right, let's hit the headlines first. The S&P 500 finished the day down about 1%. The Nasdaq 100 closed down about 1.2%, and the Russell 2000, small caps, slid about 1.5%. That's a pretty clear risk-off tone.
Yep. And to put that in plain terms, the leaders that had been running recently carried the biggest weight. Investors stepped back from momentum and growth names and moved into more defensive corners.
So what really stands out here is the gap between the large cap tech weakness and the small cap weakness. Why did small caps get hit even harder?
Small caps are typically more sensitive to growth worries and funding concerns. When uncertainty about policy or inflation rises, traders prefer liquidity and firms with stronger balance sheets. So the Russell 2000 falling more than the S&P 500 made a lot of sense.
Right. And the other thing is, tech weakness seemed to lead the way. Was this mostly profit-taking after recent rallies?
Exactly. I mean, when you step back and look at this, momentum names that drove the market higher in recent months were vulnerable. Profit-taking accelerated after a stretch of big gains, and when headlines around tariffs and utilities cropped up, it gave traders a convenient excuse to trim positions. And to add to that, certain earnings and filings created headline-driven volatility, especially in biotech and small-cap industrials.
Let's dig into sectors. Technology and communication services led the decline, a pretty common pattern when the Nasdaq 100 underperforms. But some sectors held up, right?
Yeah, utilities and pockets of energy were relatively steady. Utilities acted as a relative safe haven despite some supply and storage concerns. Energy had support from stories around grid upgrades and investment in carbon capture, utilization, and storage. That helped offset weakness elsewhere.
So utilities were a refuge, even though there were specific risk flags. Not a great day for chip names and ad-sensitive businesses, though.
No. Semiconductor demand worries and ad spend sensitivity weighed on parts of tech and communication services. That created that headline-driven selling you mentioned earlier.
Quick reactions. Yeah, that tracks.
Right.
Let's talk company movers. Lowe's kept outperforming relative to Home Depot after strategy notes about operational improvements. Then in healthcare, filings from Gilead Sciences and Axsome Therapeutics sparked volatility. And in industrials, Steel Dynamics and Sturm Ruger had filing-driven moves. Tell me about why filings can swing these names so much.
Filings like 8Ks can reveal material developments, anything from asset sales to regulatory updates or changes to guidance. Small and mid-cap names trade on news flow more than larger caps. So when a biotech files something, even if it's narrow, it can create big price swings because expectations are concentrated and liquidity is lower.
Makes sense. And real estate had its own noise. Deal momentum and fresh filings for some REITs kept that space choppy.
Yep. M&A chatter and financing dynamics were the focus there. Individual REIT filings can change perceived risk profiles quickly.
Quick aside, crypto-related equities and tokens sent mixed signals, and that bled into equities with crypto exposure. Honestly, I was a bit surprised by how sensitive some stocks were to that cross-asset noise.
Yeah, crypto volatility often spills over into stocks tied to trading volumes, payments, or blockchain exposure. When crypto was choppy, those equities widened out as well.
Okay, shifting gears to macro and the Fed. The market acted cautious. Traders trimmed exposure and priced in a slower move to rate cuts. Walk us through the reasoning there.
Market pricing reflected a recalibration of risk premia. With some inflation measures still above the Fed's long-run target and labor markets holding up, investors grew less confident that meaningful rate cuts were imminent. So they became more data-dependent, waiting for core inflation prints, payrolls, and Fed comments.
Right, so the near-term catalysts are basically those macro data points and any Fed speak. If inflation surprised to the upside, we'd see extended risk off, correct?
Correct. Stronger than expected inflation or hawkish Fed rhetoric would likely extend the sell-off. Conversely, a dovish surprise or calming tariff headlines could spark a quick re-risk.
Let's make one thing clear for listeners. When we say breadth deteriorated today, what does that actually mean?
Breadth simply refers to how many stocks are participating in a market move. Deterioration meant more names closed lower than higher. The selling was broad rather than concentrated, especially in small caps. That's a caution flag, because a healthy rally wants broad participation.
Short reaction. Hold on. Say that again.
Breadth down equals fewer stocks joining the rally or more stocks joining the sell-off. Not great for a sustainable advance.
Got it. Technical picture. If major indices close below recent consolidation zones, that opens the door to deeper correction. But buyers could step in on a high volume rebound to signal this was just a pullback. Talk through that playbook.
From a technical perspective, confirmation matters. A low volume bounce after a sharp sell-off suggests sellers remain in control. A high volume reversal, especially with improving breadth, suggests selling exhausted and buyers are returning. Traders look for those signals to decide whether to fade weakness or ride it.
Quick check. For traders versus investors, what were the practical takeaways today?
For traders, watch for stabilization. A day with narrower breadth and stronger volume on up days would be constructive. Failed bounces at key moving averages would favor short positions or defensive rebalances. For investors, use selective weakness to look for high-quality businesses with durable cash flows. Don't overreact to a single down day.
And on monitoring risks, tariff developments, credit and funding signals, and crypto flows, all can change the narrative quickly.
Exactly. Tariff headlines can reprice margins for retailers. Small cap stress argues for watching credit spreads and bank lending. And crypto can leak into equities via exposure channels.
Putting the day in perspective. Historically, this looked like a classic profit-taking episode after concentrated rallies in growth and AI-linked names over the last year and a half. It wasn't a market panic, but it marked a shift from risk-on to risk-aware positioning. Short reaction? Big move.
Yes, and the key question now is whether this is transient rotation or the start of something broader. The next few macro prints and Fed commentary will be decisive.
Before we wrap, give our listeners 3 clear takeaways they can act on tomorrow.
1. Watch the Fed calendar and core inflation prints. They will steer sentiment. 2. Monitor breadth and volume. A high volume bounce with improving breadth would be constructive. 3. Be selective. Use pullbacks to evaluate quality names rather than wholesale reallocations.
Great. Quick reactions.
Right.
Jonathan, any final thoughts on position sizing or defensive spots right now?
Keep position sizes manageable and avoid concentration in momentum trades that already ran a lot. Defensive areas like utilities and certain energy service names offered some shelter today, but don't forget to assess fundamentals. Not all defensive labeled names are equal.
Sound advice. All right, that's our wrap. Bottom line, markets closed down with the S&P 500 down about 1%, the Nasdaq 100 down about 1.2%, and the Russell 2000 down about 1.5%. Sector and company-specific headlines amplified the pullback, and the Fed and macro calendar will be the main event for what's next.
Thanks. Stay disciplined. Watch the data and be mindful of liquidity in smaller names.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. That's Alpha Recap. Thanks for listening, and we'll see you next time.